buy term, invest the rest? Possibly. That could be the right financial strategy for you. If you take a walk with me real quick, um, we'll discuss a few different strategies that you could have and that you could do to see if it's right for you. So, one thing we need to understand with any financial solution is that not one size fits all. Simply put, what I mean by that is you have to understand the ups, the downs, the pros, the cons of what each strategy means for you and the financial goals and the objective state that you and your family want to be. So let's analyze buying term and investing the rest. This is a strategy that came about in I'd say the late 80s, early 90s, and really gained popularity in the early 2000s. This strategy consists of buying cheap term, well, let me not say cheap, but buying, for most Americans, affordable term, and instead of investing that money in what most Americans used to do in the 80s, in a whole life policy, or investing it currently in an IUL or a universal life policy, they'd invest that money that they're now saving by putting and getting a 20 or 10 or 15 or 30-year term. They'd invest that money that they would have invested in a whole life policy into a stock, into a bond, or I guess any other type of investment. So before I keep going forward and analyzing this strategy, let's reel it back a little bit. You see, back in the 80s and 90s, the stock market for, I guess, most Americans had unprecedented growth, anywhere from about 15 to 16 to even 20% in some markets. And so this strategy at that specific time made a lot of sense for a lot of people because easily, if they had their money tied in to a certain asset in the market and their money could, let's bring it down a little bit, not 16, not 20, their money could be giving them a return of about 10% per year. Of course, it made a lot of sense for a lot of people who had a lot of different assets to invest in that, to get rid of their whole life policies, to get rid of their IUL and universal life wasn't necessarily that popular yet, and IUL wasn't even invented yet, but to get rid of their permanent insurance policies and invest in a regular term policy that for a lot of folks is going to expire, that strategy made a lot of sense. But if we look today at the volatile market that we currently have, the ups, the downs, the different types of investments that people are like, yes, this is the next big thing. But then the next year is completely gone. So today, one thing you might have to ask yourself, is this still a viable option for me? For some, I do believe it is yes. And for others, I believe no, depending on the type of person that you are. So as we analyze this topic further and we look at some of the pros and cons of this financial strategy, some of the pros obviously would be, so let's say you were able to get a rather inexpensive term policy and you were able to find a decent strategy that was able to get you that 10, 15, 16% that you may have gotten back in the 90s, that obviously would be a pro because it would be inexpensive enough where you could still save the amount of money that you would have comparatively to you getting a whole life policy, and you would be able to invest it in, let's say, a stock, a bond, or some type of option, if you know what I'm talking about. And you would have been able to make those returns that would make it quote unquote beneficial for you to have not invested in that whole life policy while you were younger. So this investment strategy is more for people who are somewhat not necessarily in their golden years, like 65, 75 years old, but more people who are kind of, a little bit younger, 25 to about 35 years old. That's who this typically is mostly for, and sometimes around like 40, 45 years old. Um, However, the downside of that would be, let's say the market isn't doing that good. Let's say you're not getting the amount of returns like you thought you would have gotten, and let's say the market in a specific year or specific few years, instead of getting you 10%, 8%, which is on average 8%, or let's say 15% is doing really good. Let's say for a few years it's not getting you any of that. And the market had a bad year where it did 20%, with negative 20% or negative 15, or let's say it evened out and just did zero. Would it still make sense if the money that you would have lost, it'll take you about 7 to 10 years to make it back, comparatively to if you would have gotten a steady rate of return for those 10 years or 6 years or however long the investment process or plan was for you, instead of you getting those 6%, including the 4% interest given to you from the insurance company, plus the 2% dividend? Would it still make sense to give up that steady rate of return for, I guess, the chance to possibly get 8 or 10 or 15 year, or 15% interest on your money? Possibly. For some, if that strategy makes sense for you, I suggest that you do that. Now, for most people who um, want, that steady rate of return and want to make sure that, the whether it's the 50, the 100, the 150,000, 200, 500, a million dollars worth of death benefit that they have in their policy, they want to make sure that that stays there, because whole life, term, IUL, universal life, whatever type of insurance policy you have, it's not necessarily just the investment platform or portfolio that the insurance policy comes with. It's the death benefit. It's because you want something to be there at your family's worst day possible when they no longer have you. So do you want to play that risk while you're young and hope that you don't outlive your policy, you don't outlive the term of the policy? Do you want to hope for that, or do you want to invest in something that's going to give you that steady rate of return for the long haul and also give you a decent amount of cash value as well? Now, I'm not your financial professional. I'm not your agent. Now, if you'd like to get some more information from us and from my team, what you can do is you could, go into the comments. You can direct message me depending on which platform that we're on, and reach out to us, and we should be able to possibly help you if we can. So I want to say, hopefully you've learned something from this video, and you guys have a good one.